Kia ora, everybody. A very warm welcome to the FSC's ReGenerations Reimagined conference. We are happily now in week 2 of our 6-week online, twice weekly show. And I hope everyone had a wonderful and safe long weekend. Mindful that you may be beaming in from somewhere in New Zealand if you're in Auckland. Hats off to you. I think we're 10 weeks into the lockdown. And if you're outside of Auckland, please enjoy teas and coffees and all those fabulous things that we would love to be doing with you. Folks, today's session, in fact, all sessions, wanted to shout out to the fantastic group of sponsors of the FSC ReGenerations conference, and in particular for today's session to the team at Cigna. These big events can't ever happen unless you get people and organisations really supportive behind it. And a big thank you to Cigna and indeed, as I say, to all our sponsors. All FSC conference content has been curated by our wonderful conference committee. So a huge shout out to the conference committee. I think for most people who've been following the word on the street, we were going to be in person in September. Of course, that didn't quite happen, and so we've moved into a digital framework. And whilst it's suboptimal or perhaps not as good as being in the flesh, it's still fantastic to be able to connect in with everybody on a regular basis. And last week we were lucky enough to have Rob Everett for his last conversation. We had a fantastic discussion on the future of financial advice, and there's plenty of fantastic stuff coming up. So commend you to have a look at the program and just dip into what you like. And of course, with all of these events, they are on the record, they are being recorded, they are then going to be published. And so if you happen to miss out on a particular session, you can always do catch up FSC conference in the quiet of your own time. Folks, with that, it's my delight and pleasure to welcome Ben Coulter to join us today for today's session, which is an introduction to IFRS 17. For the last several years now, there's been a very active IFRS 17 working group within the FSC community, fantastically co-chaired by Sean Cam and Ben Coulter. And I think for everyone, it's been a pretty big learning curve as the IFRS timeframes has drawn closer, the consultation has taken place. And today's really designed as a bit of an introduction to the topic of what is IFRS 17, how might it impact your business, what steps should you be taking? And really with Ben in the chair, we're in very safe hands. He has been one of the thought leaders on this topic. He has been one of the people who've helped the industry kind of think up, frame up, and develop the appropriate strategy. So Ben, thank you for your work prior to today. And today's session, of course, is really that introduction. So without further ado from me, a very warm welcome, Ben, to you. And at the end of the show, we're delighted to have Simon Toole from Cigna to say a few words and vote of thanks. Ben, over to you, and thank you again.
Thank you, Richard, and tēnā katoa, everyone. So I'll just pull up the agenda now in terms of what we're going to run through. We've got a little bit of a recap on the IPSA review to start with before we do get into IFRS 17. And then we'll touch on the interim solvency standard as well. So I guess, as Richard pointed out, I'm the co-chair of the FSC's IFRS 17 working group. Been working alongside Sean Cam for a number of years on IFRS 17. Across the industry, getting everyone up to speed. But in my day job, I lead the actuarial practice at PwC as well. So actuary by trade. So feel free to drop me comments if it's getting too technical, and we'll skip through it. But I'm sure hopefully everyone will learn something. And certainly, as they say, the only thing that's certain in life is death and taxes. Regulation's not far behind with IFRS. So let's touch on IPSA review first and foremost. So IPSA, in terms of the background to IPSA, so the Insurance Prudential Supervision Act 2010 is the primary piece of legislation for the insurance sector. It was introduced in 2010 for the first time ever, so it was very new, and in fact it received the royal assent 3 days after the first major Canterbury earthquake, so it was very timely in its inception. And what that piece of legislation does, it appoints the Reserve Bank of New Zealand as the prudential supervisor, or the regulator, and requires other things of insurers, such as a risk management framework, the need to appoint an actuary, statutory funds for life insurers, and so on. But IPSA gives the Reserve Bank powers to create solvency standards, which are regulatory capital standards, and enforce them and carry out distress management in extreme circumstances. Now, the International Monetary Fund, or the IMF, carried out a financial services review, the FSAP review, in 2016-17 into the Reserve Bank in terms of how they carried out their prudential supervision. They found highlighted a number of recommendations for how the Reserve Bank could do better. And similarly, the Trowbridge-Skelton's report into the Reserve Bank's supervision of CBL insurance also created a number of similar recommendations to the FSAP review. And to act on those recommendations, changes to IPSA, the fundamental legislation, need to be carried out. And that requires quite a bit of lead time in terms of consultation with industry and feedback to the Reserve Bank, and then changes through the bill and the drafting process. So changes would also be required in respect of IFRS 17, and we'll touch on that in a second. But one example would be the small insurer exemption that's currently within IPSA, written into IPSA itself, refers to premium income. And as we'll see later on in this presentation, premium income will no longer be on the P&L, it will no longer be on the income statement of insurers' financial statements. So there will need to be slight adjustments even for IFRS 17. Now, the IPSA review commenced in 2017, but with an issues paper initially, but the review was put on hold, primarily to focus on other priorities, including conduct and culture, and the review recommenced in October 2020, and there's a staged series of consultations, which we'll see on the next slide. So in terms of the first options paper that has been consulted on, that covered the scope of the Act, overseas insurers and outsourcing as examples, and really what that was designed to do was ensure that the Reserve Bank is capturing within IPSA the entities that it should be capturing. So one unique feature of IPSA is that it does rely on the Companies Act definition of a company and requires a physical presence. So things like that were consulted on in this options paper. Consultation closed November last year, and it's hard to see how the time flies by, with especially with Delta over the last few months. But yeah, 30th November was when it closed consultation on that options paper 1, and feedback was published on the 22nd of July for that first options paper. Options paper 2, which is focusing on policyholder security and thinking about things like solvency requirements, statutory funds, and even whether the Reserve Bank should introduce a policyholder guarantee scheme for insurance companies, is being consulted on right now, and consultation does close on the 15th of November for that one. Now, in terms of the FSC response to this is all managed through the Regulation Committee, which is separate to the IFRS Working Group. The IFRS Working Group feeds up to the Regulation Committee ultimately. So if you do have any thoughts or feedback on that options paper 2, do make sure you get those responses in quickly through your Regulation Committee contact. But that's not the end of it. The IPSA's still got a wee way to go in terms of consultation. So future option papers will cover things like enforcement provisions, and we understand that's the next cab off the rank, expected to be early 2022. But there's also disclosure requirements, regulatory mechanisms, and we'll get into that a little bit further in the interim solvency standard later on in terms of what that might look like in practice. So once those consultations are wrapped up, drafting of legislation is expected in late 2023, but we're already seeing some slippage in terms of the timeframes towards this. So late 2023 is our best estimate of the timeframes at this point in time, but there may be further slippage if things become more complex than originally anticipated. Right, so let's get into IFRS 17 now. So the background to IFRS 17 is it's a standard for accounting of insurance contracts. So this applies to insurance companies at the moment, and within New Zealand, New Zealand insurers with for-profit entities are required to follow NZ IFRS 4, the current insurance contract standard. And Appendix C applies to life insurers, and Appendix D applies to other insurers, which are general and standalone health insurers. Now, IFRS 4 was only ever meant to be a temporary standard. It was never meant to be a permanent one, and that's why they dealt with the two types of insurance business in the appendices. And there's been a 20-year-long project run by the International Accounting Standards Board, the IASB, to try and get international comparability and consistency and make sure everyone's on the same basis. So the IFRS 4 effectively grandfathered all of the existing approaches to accounting. So, you know, if you're looking at an insurance company in terms of how it accounts for its business in the UK, it's very different to Asia or Australia and New Zealand. The approaches are very different. Hang on, I've just got a chat message. So just before we move on, I thought it'd be good to highlight just in terms of as we wrap up the IPSA review function. It was noted that last week the third options paper in the IPSA review, enforcement regimes, penalties, distress management and resolution, will be released in February 2022 for consultation. So thanks for that update. Right, so back to IFRS. So IFRS 17, 20-year journey to get to this point. Now, early in the piece, the IASB had a bit of a falling out with the American equivalent, the FASB. So they parted ways early on. So IFRS 17 will largely be an internationally consistent standard, except for the USA. So USA have its own standard, long duration contracts standard, which is similar in a lot of ways to IFRS 17, but it's not identical. So unfortunately, they didn't achieve the objective of making it globally consistent, but it's most of the globe except for the US. Now, the effective date for NZ IFRS 17, so the New Zealand Accounting Standards Board has adopted it in full, the international version. The effective date is reporting periods on or after 1 January 2023. So if you have a 31 December balance date, that will mean the first full set of financial statements required to be IFRS 17 compliant would be 31 December 2023. But you probably have to do some half-year financial statements at 30 June 2023. If you've got a 30 September balance date, then the full set of financial statements would be September 2024. So it's over the period of the next few years, but the opening balance sheets are fast approaching for the comparative periods that are required in the disclosure of the financial statements. So we'll flick on to the next slide in terms of how IFRS 4 currently works, because to get an appreciation and understanding of how IFRS 17 might affect the financials, it's really good to understand how IFRS 4 works and how insurance companies do account for their profits that they do make, if there are any. And so in this example, what we've got here is a typical yearly renewable term life contract. And the blue bars on the chart there are the net cash flows. So in the first year, there's a big net cash outflow. And that's representing the acquisition costs in respect of whether you're a direct or intermediated business, so the marketing, and underwriting and administration, as well as some initial commission costs that go out. But those don't get recognised immediately in the profit and loss statement. So that's why a growing business can still report IFRS profits, yet it still needs a strong capital base to fund the net cash outflows in that first year. So effectively, the principles guiding the release of and recognition of profit for under IFRS 4 is that profit needs to be recognised in line with services provided over the full life of the contract. So if the customer keeps renewing with a decent persistency rate across the portfolio of contracts, the profit needs to be spread across that entire lifetime of the contract. The other guiding principle is that any losses are recognised upfront in full. So you capitalise the full value of those losses and recognise them upfront if the whole product is unprofitable. And the impact of changes in interest rates impact profit in the current year. So you can see in that chart there that the profit emerges smoothly over time with those yellow bars, slightly less in the first year because there's a selection effect, but gradually reducing over time in line with lapses. Now let's have a look at what happens under IFRS 17 and how that does vary. So on the next slide, we've got IFRS 17. And this, again, is a similar contract, so a yearly renewable term life contract. But it's now considered under IFRS 17 as a series of one-year accounting contracts. So each year it renews, it becomes a new accounting contract. That's because some of the technical definitions around contract boundary mean that there's a full repricing right at the one-year renewal point that becomes one-year accounting contracts, which is more similar to how other contracts are accounted more broadly under IFRS 15 for non-insurance type business. So acquisition costs that aren't expensed immediately can then be allocated to future renewals on a systematic and rational basis. Now, what that means is really up to the insurer. There's various rules that they could follow or adopt to meet that systematic and rational definition. But one example here is that they're allocated in line with the expected premiums, and so acquisition costs are allocated each renewal period in line with the expected premiums. And what you see there is that the profit in the first year is much higher. In the second year, it's a little bit higher than under IFRS 4, and then it gradually reduces. The reason, so IFRS 17 is accelerating the profit for these types of contracts. It's bringing more profit up front, which is a nature of just the mechanisms behind the scenes, but also the move to treat these type of contracts from an accounting perspective as a series of one-year contracts. I think that's really, really important to understand the financial impacts. It's really one-year contracts now. The other really important thing to note is that the total amount of profit under any accounting standard change is not affected. The accounting standards only affect the timing of profit when profit's released. It doesn't affect the total. The total amount is really, once it's all the contracts are settled and completely run off, you've got your cash inflows less your cash outflows, and that becomes your profit. So the accounting standards just change the timing of how that is released over time. Now, this is a highly simplified example of one particular contract. There are lots of other types of contracts out there, health insurance and even reinsurance, that have their own considerations, and underlying contracts have to be separately considered compared to reinsurance contracts going forward, which is also a quite a substantial difference to how IFRS 4 currently works, which is often on a net of reinsurance basis. So there's a lot more changes to come in the income statement, but also in the disclosures, as well as all the technical interpretations. But you get the sense with IFRS 17, once you get into the depths of it and go round and round in circles with the circular nature of the standard, that you find that there's less of an overarching principle of profits emerging in line with services provided like you do have under IFRS 4. It's more principles-based, but at a much lower level with lots of different principles that aggregate up to something that's that can be quite confusing at initial face value. So let's have a look at the income statement on the next slide in terms of how that's expected to change. So this is a separate example of an income statement for a 5-year level premium contract in its first year of after being issued. So under IFRS 4, for those of you that are familiar with the accounting arrangements under IFRS 4, you've got premium income on the income statement or the P&L. Then you have claims expense, operating expenses, and then a movement in life insurance contract assets. So profit before tax becomes $559 in this particular example. Under IFRS 17, it looks quite different. So you've got this concept of insurance revenue, which is similar, but it's not equal to premium revenue. It's probably a suitable proxy, but it's built up of expected claims, a release of what's called the contractual service margin, which is unearned profit, a release of a risk adjustment, which is a margin for risk, and some acquisition cost recovery component as well. So it's almost like a bottom-up view of premium income rather than just taking the premium income as it's receipted. The next item is insurance service expenses, which aggregates all of the claims expenses and the operating expenses together, as well as has an element of the movement in life insurance contract assets in there too. So that number, you can no longer see claims and expenses split out. So you wouldn't be able to immediately pick up a P&L or an income statement post IFRS 17 and simply calculate a simple loss ratio, for example. You'd have to dig deep into the disclosures within the financial statements to get those loss ratios. The other new feature is the finance income expense from insurance contracts. It's a new item and it reflects some of the discounting aspects, both in terms of how the discounting unwinds over time on elements of the insurance liabilities or assets, but also the effect of changes in discount rates as well that can come through that line. There is an option to put it through other comprehensive income as well, but won't go into those options. But what you can see, and it's consistent with the previous example on the previous two slides, is that you can see a higher profit before tax in that first year under IFRS 17. So the effect of that front loading of profit, bringing it slightly forward with a $612 profit before income tax as opposed to a $559 income statement, bottom line. And that's really due to the contractual service margin, the CSM runoff pattern. It's bringing the profitability forward over the 5 years, but it doesn't change the total profit over those 5 years. So next is the practical considerations in terms of implementation of IFRS 17 and what we're seeing emerge through the FSC working group. And we won't go into any of the technical issues such as contract boundaries or level of aggregation. We're really focusing here on the practical implementation issues. So one of the first ones is really historical data. Now, this is a one-off exercise. Effectively, IFRS 17 requires you to go back right to when contracts were first issued and incepted, apply IFRS 17 as if it was always in effect, and then roll it forward to your transition date, which might be for 31 December companies, 31 December 2023 for your first transition date. But you'd have to do balance sheets before that as well for your comparative years. Now, that presents some practical challenges when you've got very historical legacy business, for example, going back a number of years, with data models and assumptions just might not be readily available. But you have to prove that it's impractical to go back in time and get that data, to use some of the other transition options available under the standard, which provide some relief to going back in time. So it's quite a difficult exercise to prove that data just simply isn't available. You have to go and look for it first before you can decide. The other complication with that historical data as well is the business combination rules are different under IFRS 17, and that adds further complication if there has been acquisitions and mergers over time. The next practical implementation challenge is really around profitability buckets. So in terms of how contracts are grouped together, insurance contracts, there's a bucket that are onerous at inception, which means the loss making. There's a bucket of contracts that have no significant possibility of becoming onerous, and then there's another bucket. Now, the standard doesn't require you to go looking for unprofitable or onerous contracts, but it needs to be based on reasonable and supportable information or facts and circumstances. So what that's likely to lead to is more profitability groupings of insurance contracts, a bit more focus at a more granular level on profitability. And if you do identify some loss-making contracts, then those losses are recognised up front, and it leads to more volatile results over time. The next emerging issue is really the ongoing needs of data, and one of the big changes to how IFRS 17 works is fundamentally it's more based on cash flow and cash received or cash paid, as opposed to more an accruals nature of accounting, which IFRS 4 can deal with. So it's quite a different concept, which means the data flows behind the scenes into the general ledger through your admin system. There needs to be additional reconciliations more at a cash level than at an accrual level. So if you're billing someone for a premium receipt, it's really based on when you receive that cash is when it starts to flow through into the IFRS 17 accounts. So all of those behind the scenes journal entries and how cash is receipted and paid can create a lot of work depending on how your systems are set up, which leads nicely to the next practical consideration around systems and processes. So there are significant opportunities to fix existing inefficiencies in financial reporting. Think about how your actuarial and finance teams all link together to provide to produce the financial statements. There's often a lot of manual handovers between one team to another using a simple Excel download and then upload into another Word document, maybe only for that disclosure. Then you have to go to another team for another disclosure. It's often quite disjointed and not consistent. And there's, you could carry that on with IFRS 17. You could continue those manual processes with those manual uploads, but with the detail and the extra level of complication in the disclosures with IFRS 17, with additional reconciliations and additional just general disclosures around your insurance contracts, what you'll find is that the increased risk of manual error, human error in those manual processes may lead you down to a path where you want to take the opportunity, once you're implementing this new standard, to automate some of those downstream processes and make them a bit more efficient, so you can free up some time to get back to looking forward in your business rather than looking backwards. The fifth area, which I think is probably, it hasn't really been touched on too much in this market yet, but it's certainly gaining traction globally, is really on how to explain results coming out of IFRS 17 financial statements. You look at them and the results just aren't intuitive. And using the example on the slide before with the income statement, it's quite hard to figure out what insurance service revenue means or what insurance services expenses means. You can't necessarily explain it. And then in addition to that, the extra complication, particularly for life insurers, is really the split between gross underlying contracts and then reinsurance contracts. So potentially you might see insurers start to talk about different measures and explain their underlying result and their reinsurance result separately, because they're accounted for in different ways, with reinsurance potentially being long-term for most cases, and the yearly renewable business on the underlying contracts all being short-term, so they look very different. And as a result, off the back of that, once you explain those results, new key performance indicators for management incentives may need to be created, whether it's a full move to another valuation measure, such as embedded value or value of new business added, or using some new metrics coming out of IFRS 17 is yet to be decided by many insurers. And last but certainly not least, is really the level of effort required to implement IFRS 17. You know, there's certainly a growing concern there's probably not enough resource globally to implement this, and certainly locally we're not immune to that, particularly with borders shut. With COVID-19 has not helped getting some extra resource in and keeping them here to really get those projects underway. So just to give you a sense of the level of effort, large insurers tend to have teams of up to maybe a dozen people working on IFRS 17 at this point in time, getting up to speed with both the systems, processes and data side of things, and starting to implement new models and create the IFRS 17 compliant financial statements. So it's quite a resource strain that needs to be pulled out of existing BAU environment. So irrespective of what role you play in the industry, this level of effort and the resourcing need will be a given for all insurers out there, and they will have those strains on resources that may prevent them from acting on other projects such as new products or solutions. So my last slide on the next one on IFRS 17 is really just touching on the objectives of the IFRS 17 working group. So what we aim to do is review the standard and emerging guidance, work collaboratively on the transition and interpretation, communicate these findings to various members and including FSC members more broadly. And then where appropriate, we consider endorsing overseas guidance and become an expert group on IFRS 17 and assist the Reserve Bank. So the ways we do that is through the FSC working group meetings, but we also have FSC technical focus group sessions where we dig really deep into some of the technical issues. For example, reinsurance, how insurers are thinking about interpreting different parts of the standard with regards to their reinsurance contracts. It's really helpful to discuss various views of interpretation. There's no mandated this is right, this is wrong, but it's to openly discuss views on interpretation to hopefully get up the curve of interpretation quicker than market practice where we don't talk to each other. And in terms of the context with the Reserve Bank, we meet with the Reserve Bank monthly to talk about evolving issues regarding IFRS 17 and how it pertains to solvency standards, which is what we'll get onto next. So before we move on to the interim solvency standard, I'll just pause there just in case there's any questions, comments on IFRS 17 so far. So we've got one that's come through, and given the level of effort required, resources and costs, is IFRS 17 seen as a preferable approach to IFRS 4 to an organisation? Is it a short-term outlay for long-term gains, for example? What are the benefits? Is the amount of resourcing as significant for a smaller entity? All very good questions. So in terms of the level of effort and whether it's preferable, I don't think we really have much say in the matter, to be fair. I mean, my personal preference is I quite like IFRS 4. I'm quite used to it. IFRS 17, I think, is a bit more complicated. But I think we needed to compromise on the complications of the standard to achieve a globally consistent standard. So while there's less variation to IFRS 4 in the current market, IFRS 17 probably has a bit more variation because there's a few more principles that you can decide in accounting policy choices to stretch the variability, but globally the variability becomes much less. So I think for New Zealand to be a part of the global insurance community, it's quite important to be a part of that and make sure we're all on a consistent basis to attract investors in the long term. So I think that's really where the long-term gains may come. And, you know, overseas investors just being able to pick up an insurance set of accounts, insurance company set of accounts, no matter where in the world they are, and understand exactly what's going on. So I think that's the long-term benefit, just putting us on the international map. And in terms of whether resourcing is as significant for a smaller entity, it really depends. I think for a smaller life insurance company, maybe not as much less in terms of effort. If it's a smaller general insurance company that's very profitable, there are simplifications that you can apply in terms of the premium allocation approach, which would simplify the accounting quite significantly and be more consistent with what's currently done under IFRS 4 under Appendix D. So I think it really depends on the complexity of your products, your historical arrangements, previous business combinations and acquisitions. And we've got another question as well. Will IFRS 17 potentially move general and life insurers closer? And the answer is definitely yes. It will move them closer in terms of the accounting. There will be less of a divide between general insurance and life insurance. It will be more, there'll be long-term contracts and short-term contracts. Now, short-term contracts could be either life or general, and long-term contracts could also be life or general. So it's going to blur the boundaries quite significantly in terms of the accounting, but the underlying risks don't change. So I think when you're looking at this from a risk perspective in terms of how you manage and mitigate risks, you'd still be looking at the underlying product features, and you still see two different industries in that regard. Cool. Well, thank you for those questions. Let's move on to the next slide, which will talk about the interim solvency standard. But before we get into the details of what the Reserve Bank has released in terms of the interim solvency standard, I thought I'd give you a bit of background around what solvency standards are. So they're there to set the level of regulatory capital for insurers. It's a higher level of capital than what's required under the Companies Act test or solvency test, which is effectively, are your assets greater than your liabilities? This is designed to be I mean, there's various schools of thought, but originally it was designed to be a 1 in 200 year probability of failure. So if you're holding it capital at that minimum level that the Reserve Bank prescribed, it should be 1 in 200 years that your assets would fall below your liabilities in a series of extreme events. So the solvency standards are set, or the IPSA effectively empowers the Reserve Bank to set solvency standards under Section 55. And currently there's separate standards for life insurance companies and non-life or general insurance companies. There's also a separate standard for variable annuity businesses, as well as separate standards for companies that are in runoff. And the Reserve Bank's been quite open that there is over 100 known issues with the existing standards. Some of them are simple inconsistencies and drafting errors, whereas some are more major, but it's quite a process for them to go through and update these solvency standards. Often it's been addressed with tactical short-term fixes, such as changes to license conditions, which has happened recently in the life insurance industry in response to fears of negative interest rates late last year. It's funny to see how time flies on that one. We're now staring down the barrel of a gun of rising interest rates and rising mortgage costs, but nevertheless. So yeah, the Reserve Bank have dealt with differences in the interpretation of solvency and issues there through licence conditions more recently, as opposed to redoing the whole solvency standard process, simply because it's just easier process-wise. But lastly, and not leastly, the solvency standards themselves reference and rely on IFRS 4 items heavily. So there's a need to create an interim standard for insurers that adopt IFRS 17. The existing solvency standards do not work with a company that will have IFRS 17 financial statements. Effectively, it would create a position which the industry wants to avoid, where there's dual accounting. So you're still preparing IFRS 4 financial numbers, so you can do your solvency calculations for regulatory returns, but then you're producing IFRS 17 financial statements to meet your accounting requirements. That would be two different models running in parallel. All sorts of complications behind the scenes in terms of journal entries. You wouldn't want that position. It would be very costly for the industry. So the Reserve Bank have started consulting on this interim solvency standard. So on the next page, we'll just go through in terms of the key changes. So in July 2021, so a few months ago, the Reserve Bank issued an exposure draft of an interim solvency standard. This has been long talked about, long debated, and we've through the FSC working group, we've been in regular contact with the Reserve Bank on this as well. Now, the changes proposed included a single solvency standard that covered all insurers. So it's taking bits from the non-life standard, bits from the life insurance standard, and pulling them all together. Now, that's in itself has created some unintended consequences, because what worked for non-life insurance companies didn't work for life insurance companies in some circumstances, and vice versa. The second key change is they've standardised the balance sheet, and it's really a step to make the regulatory capital framework a bit more accounting standard agnostic. So you could run these calculations effectively whether you had IFRS 17 numbers or IFRS 4 numbers. That was the intention there. Whether they've achieved that in full, I think they've probably leaned too far towards IFRS 17 numbers and relied a bit too heavily on the future state, as opposed to being truly accounting standard agnostic. But you could see what they're trying to do there and make it work under either standard. The other change is they've introduced a new operational risk capital charge, and for most insurers that would be approximately 3% of annual premium income, and that would be a capital charge that they'd have to hold reserves for effectively. So that's about 150, 160 million across the life and health sector of additional capital requirements. The other change is really around movements and existing charges. They've gone to and from being deductions from capital. You can see that the white box capital deductions in the chart there. It is noted as an existing item, but it is slightly different to the existing item. Some have moved out of that into capital charges, and some the 100% capital charges have moved into capital deductions. And one of the key ones is really around the reinsurance likelihood test. And if life insurers are required, or any insurer with long-term contracts is required to go and investigate their reinsurance contracts to identify whether they've got some financing element. And if they do have a financing element, then they may require a capital deduction in that box. The other thing they've introduced is new defined terms. So there's adjusted prescribed capital requirement and prescribed capital requirement, PCR, which are very similar to what APRA uses in Australia for its regulatory capital standards. But they've also then introduced another lower tier of requirements, which is known as the MCR, or the minimum capital requirement, and the adjusted MCR. And that indicates a new ladder of supervision. So the adjusted MCR and the MCR are set equal to 80% of the adjusted PCR and PCR. So the benchmark is in percentage terms, but it gives the Reserve Bank later, when they finish the IPSA review, an ability to switch on a ladder of intervention, so that once you get down to the MCR level, then it's a point where it's very, very serious and its resolution is needed. But between the MCR and the PCR level, you've got this graduated level of supervisory response. So the regulator will be increasingly tough and requiring more and more emphasis on a remediation plan before it gets to that really bottom tier. So it's more a graduated series of interventions, as opposed to an ambulance at the bottom of the cliff, which is what the Reserve Bank is really trying to prevent going forward. Now, the big thing out of all of this that really got a lot of discussion across the industry is the effective date was initially proposed as 1 January 2022. Now, given that we're almost in November now, that's be about 2 months away, and you've got Christmas in the middle of that. It was very impractical to be able to change models, assess impacts, and get it all right, and maybe have some peer reviews or audits over those numbers in time to meet that requirement. So, in terms of what the FSC did, on the next page, we did make submissions across 3 major themes. Now, the submissions closed on the exposure draft on the 1st of October. And the FSC voiced its concerns across these 3 major themes through its submission. The first one being the time frame. The effective date was, as I just mentioned, too soon to allow insurers to change processes. If there was a need to raise capital, it would be very, very hard and challenging to raise capital in that time frame. The second one was there were significant capital impacts. I mean, 2 that are clearly identified, but one that was very uncertain as well. And this affected both life and health insurers. So the operational risk charge, as I mentioned before, potentially adds another 150 to 160 million of capital across the industry. And then the changes to the interest rate risk charge, which is again was potentially an unintended consequence of picking up the non-life solvency standard and dropping it into this new interim solvency standard, could add capital of up to $1 billion across the life and health industry, which is a significant margin, given that that would more than double the current tangible capital requirements across the industry. And then the third point is really the guidance around the likelihood test for reinsurance contracts. Didn't really have a known quantification impact, but could add significant capital requirements as well, depending on how you interpreted the guidance coming out of the Reserve Bank. So I think all of those combined with those capital impacts, what would happen would be the insurers would have to raise that capital and hold additional reserves for this. Some of these could be mitigated, maybe, for example, by hedges or something creative, but they would also come at a cost, and the insurers would then be looking to get a return on that capital, which ultimately would lead to higher insurance prices. So it'd be pushing up the cost of insurance across the industry, which is not a great thing for customers. The third theme was really the consultation process, and this came through strong in our submission. But there is an overlap with the IPSA consultation. You know, the option paper 2 is related to policyholder security, which touched on solvency requirements and similar items, which are directly related to the solvency standard itself. And in effect, the the consultation probably should have been the other way around. The IPSA review should have come first before the Solvency Standard. But we understand the reasons why the Reserve Bank have done this, and it's to the earlier point, they need to get something interim in place for companies that are adopting IFRS 17, rather than wait and have this dual accounting period that would be more costly to the insurance industry. The other point around the consultation process is that there were 15 insurers out of approximately 60 that were invited to participate in the quantitative impact assessment initially. And they were provided with additional information in terms of how to interpret certain items, particularly in regards to the reinsurance likelihood test. So that created some ambiguity as to how companies would go about and assess the impacts if there was mixed messages coming through. So I think the process itself was a little bit confusing, and maybe the ordering wasn't quite perfect if they'd had the luxury of having more time effectively. So on the last slide, we'll just run through the next steps in terms of how we set for the interim solvency standard. So on the 5th of October, the Reserve Bank announced it's deferring the effective date to January 2023, so an extra year, and it now aligns to the effective date of IFRS 17, which is great news for the industry. So it came out very soon after the consultation date closed and made that announcement. It's very pleasing for the industry. It's also currently considering changes to the interest rate risk capital charge to avoid those unintended increases in capital. So that's the up to $1 billion increase noted on the previous slide. So both of those combined, are very good news for the industry, and it's really showing that our lobbying efforts and our conversations with the Reserve Bank are paying off. They are listening to us and our concerns. There's still a few other areas that need to be worked through in terms of the areas of uncertainty. For example, with a health insurance, is it short-term or long-term? And also the operational risk charge is, while it looks set to remain at this point in time, our recommendation in the submission was really to push it to the second phase of their solvency standard calibration, which happens as part of the IPSA review. So that's still potentially on the table, but at this point in time, it looks more likely to stay in this phase of work. So our next steps is really just to continue working collaboratively and proactively with the Reserve Bank as they refine some of the details of the solvency standard, because this is where the FSC working group in itself is most powerful in terms of influencing that direction of travel. Right, so I'll pause there. We've got about 8 minutes left for questions, and it would be great to hear any questions. So it looks like not many questions coming through. That's fine. It's definitely a lot to absorb and take in. All right, here's one. What's your view on the 10% probability being applied to the reinsurance likelihood test? This is what I hinted at before in terms of one of the areas of uncertainty that's left to be decided and debated around a 10% probability being introduced in the guidance of the reinsurance likelihood test. What that does create is potential additional capital requirements for anyone with reinsurance business. And it has some unintended consequences of potentially capturing reinsurance contracts that are not financing in the usual sense. So the recommendation through the FSC submission was to remove the likelihood test completely. that we don't think it's achieving the objective that it's set out to, and it's not necessarily identifying purely financing reinsurance treaties. So I think the response there is definitely to remove that test and replace it with some other principle-based approach. Cool. So next question coming through. If an organisation is struggling to make the required adjustments, do you think the Reserve Bank would consider a path to compliance? And I think the answer is probably no. I think the Reserve Bank would set the rules, and if you're not complying with those rules at the desired timeframes, there would be consequences. I guess the level of non-compliance would dictate the level of consequence, but no, I don't think this is a non-negotiable, especially when it gets to the solvency aspects of compliance or of complying with international financial reporting standards either. So I think it's probably one you wouldn't want to risk, I don't think. Cool. Well, thank you everyone for dialing in and paying attention. Hopefully you'll stayed awake on a very dry topic. And now I'll pass over to Simon to wrap us up.
Thanks, Ben. Firstly, I'd just like to say Cigna are really pleased to be involved with the FSC conference and to sponsor today's session. And thank you to everyone who joined. I think more importantly, I'd really like to give a big thank you to Ben for what's been a really informative session. IFRS 17 has been a long time in the making, and the transition date is looming ever closer on everyone's horizon. The new standard is going to be more than just financial reporting, as Ben has noted, and brings a level of complexity to all of us as we run hard at implementation. I think it's going to be really important as we focus over the coming 24 months as implementation gathers pace and results under the new standard start to get generated. I guess just finally as well, I'd also like to thank the FSC for putting on the event. In these difficult times, it's great we can still get together as an industry and share thinking on a range of subjects. So thanks to Richard and the FSC for organising this and the other sessions on the agenda. Thank you very much.
And folks, with that, two thank yous. Thank you to Simon and Cigna, and Ben, thank you for your all stations tour of everything with IPSA and IFRS. And thank you to everyone who joined in the session. Fantastic. Session on Friday is going to be a cracker. We've got, we're looking at the impact of COVID on small businesses, particular focus on hospo. So we've got someone, the chair of the Queenstown Tourism Office. We have the chair or the CEO of hospo New Zealand, amongst a number of others. So going to be a really interesting conversation. Just look out for your FSC Connects on that. And this session will be available. Thanks for the engagement. Thanks for the participation. Look forward to seeing you on the next edition. And in the meantime, kia ora, have an awesome afternoon.